Thanks for tuning in for this month's Best Moments of the Futures Radio Show podcast. Futures Radio Show is sponsored by CME Group. They are the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world effectively manage risk. For access to free educational tools and resources for the active individual trader, please visit activetrader.cmegroup.com. For new show notifications, please subscribe to Futures Radio Show podcast on iTunes, YouTube, Google Podcasts, Spotify, or Stitcher. This show is also sponsored by Trading Technologies, RJO Futures, and FTSE Russell. The Russell 2000 is a key benchmark for small-cap U.S. stocks. Be sure to check out the E-Mini Russell 2000 Futures symbol, RTY, and Micro E-Mini Russell 2000 Futures symbol, M2K. To learn more about FTSE Russell and their products, please visit FTSERussell.com. I just want to get caught up with you and just hear some stats. I mean, I'm wondering, how have the micros been doing? It's been such a busy year. I know that I've been trading the micros a lot more, and a lot of my friends, and I know a lot of you traders have been as well. Talk to us about some stats on how the micros have been trading so far this year.
Yeah, it's been a lot of fun and certainly impressive, and continues to exceed our wildest expectations, if I'm being honest. When we look at launching the micro E-Mini futures back in May of 2019, we knew we were on something good, and it's only grown from there, where so far this year in 2020, trading about 1.7 million micros per day across the four equity index contracts on the S&P, the NASDAQ, the Dow, and the Russell. Almost 380 million contracts have traded across the four since we launched them. And what's been great to see is it's across over 200,000 unique accounts have traded the micros, with about half of them being new traders to CME. So it's great to see the adoption from new traders, the use from existing and the more seasoned traders like yourself, and also internationally. About 30% of the flow we're seeing these days are coming from outside the U.S., which is above average from an equity index perspective as a whole. So it's been a great story, and certainly the great backdrop for launching the micro options earlier this week.
So I heard you say that 200,000 new accounts or 200,000 accounts now trading the micros. Did you say half of them were brand new to CME?
Just about, yeah. Just about half of them are first-time accounts, brand new to CME, which has been fantastic to see. And that number is continuing to grow. So now people are still continuing to learn about the product. As you know, education is a huge focus of ours, and I think yourself as well. The more people have been educating themselves over the last 2 months, more and more folks continue to turn to the micro E-Mini futures to deploy their trading strategies, and it's been great to see.
That's huge. That just shows that our industry is growing, and traders around the globe, as you mentioned, this is not just inside the U.S. or even Europe, it's around the globe, are really liking the micros. Quick question before we get into the launch of the micro options. I know when we have the bigger products, which the E-Mini are now the bigger product, it's really the E-Mini S&P, then the NASDAQ, and then like the Russell and the Dow fall in terms of volume share, right? And last time we spoke, we talked about how the NASDAQ was really gaining on the micros. Like the NASDAQ is actually a higher amount of volume than compared to what it was on the E-Mini. Is that still the case, or where do we sit with all of the amount of volume between the E-Mini, Russell, NASDAQ, and Dow?
Yeah, that's a great question. That trend has certainly continued even in the elevated volumes we're seeing here in 2020, where when we look at the classic, or I like to say the older sibling E-Mini contracts, S&P is often closer to 60% of the total flow amongst the four, with NASDAQ doing about mid 30%, and then Dow and Russell kind of splitting it. But when we look at the micros, the S&P is only half of the volume, and NASDAQ is closer to the kind of the high 30s, almost 40% of the share of the micro E-Minis. And I think that really speaks to the fact that NASDAQ continues to be a red hot trade in the marketplace for all types of traders. And this is not unique to 2020, right? When we look at the NASDAQ performance, 2018 was better than 2017 in terms of volumes, and then 2019 was record, and now another record-breaking year for NASDAQ volumes at CME. So the NASDAQ continues to be a main focus of the active individual traders as well as the institutional traders. So I think that trend will continue And it's certainly held up here with all four micros doing about 1.7 million contracts per day.
Now, have the NASDAQ micros gained more on, I would say, the volume of what the NASDAQ is doing versus like the other products? Because the NASDAQ is growing so much in the micros, is it equivalent across the board, or is NASDAQ leading in the micros catching up to the bigger E-Mini as well?
Yeah, that's a great question. I would say, the NASDAQ is certainly doing better in that regard than the other contracts, where there actually are even days that in terms of just raw volume, not adjusted for size, the micro NASDAQ trades more than the E-Mini NASDAQ contract.
I've seen that.
So I think NASDAQ is certainly leading the way, just because it also has, as you kind of been talking about, in other areas, the NASDAQ has a slightly different price performance than the S&P. The NASDAQ is outperforming the S&P for most of 2020. There's different constituent compositions in terms of weight. So the NASDAQ offers a unique profile than the S&P 500. So what's great is you can trade them both. You can trade them against each other. You can trade them the same way. And you're really getting different types of strategies deployed. The S&P and NASDAQ are not necessarily proxies for each other in this market, which I think just amplifies the trading opportunities for market participants, particularly as they look to get involved in the micros.
When you're finding this edge, do you feel that it's really confined to a specific market? Or does it carry over to multiple markets? Because I think when a lot of new traders come in, they don't go through the process of, I think, finding a market that fits their personality, finding a strategy that fits in line with their personality and the market. Because for me, quick example, I don't trade the NASDAQ, I trade the S&P. And although they both may be indexes, to me they're completely different beasts. And my edge in the S&P doesn't work in the NASDAQ. So talk to us about how you took that edge and then found the markets that it worked the best in and then continued to refine it.
Yeah, so I think it's a beautiful question, and I think it's complex. So I think there are multiple facets to most everyone's, and mine in particular's, edge. Okay, it's really multifaceted. So the way I approach markets is the tools that I've talked about, a top-down approach. We start with the profile, we start with VWAP stuff, we start with, on higher time frames, that is, and we drop down into the intraday type stuff, what happened overnight, and then we drop down into order flow and even shorter things from there. So initially, well, let me continue to set the ground here. Part of that overall edge is starting to figure out the contextual situation, which defines that asymmetric risk-reward landscape that I talked about. If we pause right there, that I can go apply to any market out there. NASDAQ, S&P, I totally agree. They have extremely different personalities, extremely different nature to the way they move on multiple time frames. But I can go apply my top-down framework to defining the risk-reward in those markets exactly the same.
Yeah.
Okay. So that's a big deal. So I can go do that across. I can do that with cryptocurrencies, right? I can do it with anything. That's because I think that auction market theory and using profiling and whatnot, it taps into a truth about markets. It taps into the way humans and machines designed by humans or whatever operate on an auction bidding and offering basis. And certain things happen as a part of that process. So the other phase, the other component to this multifaceted thing, which is what we call an edge and on a technical basis, are now the tactics and the shorter term stuff that you go apply to time trades, to manage risk, to manage winners, to do all those type of things that we typically do on a shorter time frame basis. And that is where you have to adjust if you're going to go operate in different markets. So the higher time frame piece applies across. The lower time frame piece, I was drawn personally to crude oil, to something more like a NASDAQ, to these markets that, gold, that will drive and have more momentum and move quicker and clear out inventories because the book is thinner. I think a thinner book is the nature, a large part of what drives the nature of these markets, their personalities, as we end up calling them. So yeah, that's what I gravitated to for my strengths, or maybe avoiding my weaknesses of some impatience and things like that. But I like the faster moving markets. Now that I've grown and evolved as a trader, I have expanded my repertoire, if you will, of lower time frame, shorter time frame tactics of, you know what, you can't trail a stop, on a 2-tick range bar on the S&P because it's going to overlap, it's going to come back and get you every time, but what we call a fast trend environment in crude oil, you could trail by 2 ticks. The momentum moves that much.
And with the surge in retail trading, I mean, obviously in the futures world, it's grown unbelievable by unbelievable amounts with the micros this year. And I've talked a lot about that. I mean, I know that a lot of the people in the stock world have seen massive growth as well with the Robin Hoods and even, the Portnoys, which I think kind of bridges that in between to where he's, a DDTG or whatever it is that he does.
Yep.
And then you have, his influence in the sports world as well. And with you finding this niche, and I've said it ever since I've met you, it's just such an interesting thing because it really is bridging the gap between trading and sports. And how much we've talked about how much your numbers have grown from people getting involved, but how much has the retail trading surge, have you noticed, somehow they've found their way to you as well?
I mean, it's been incredible when you have Barstool talking about day trading every day. We're sitting here saying, I can't believe this is happening. We've been saying this for the past 2-3 years. And now all of a sudden everyone's locked down and everyone's all of a sudden opening up a Robinhood account and putting their stimulus checks in it and trading, right? For us, it's about really now having the validation that this idea is something that people want to do, and being able to really have that conversation that this is going to be much bigger a niche than people probably gave it credit for maybe a couple of years ago. For us who are in the space, right, in the trading space, I don't know that there's this middle ground. I think people either love or hate it, right? It's if you're a trader, you love this and you are glued to your screen and you are glued to CNBC or you are glued to understanding how the markets and why the markets are moving in a certain way. So if we're able to, like you said, create that bridge between trader finance into sports fan and sports, there's a direct correlation already to those people. We're just hopefully creating a platform that they now get to engage and enjoy what they were doing from 9:30 to 4. Now they get to do the same thing for Monday Night Football or for, Game 7 of the NBA Finals.
Traders, we're going to pause for 30 seconds and we'll be right back. A question I constantly get is, what platform do I use to trade futures? Well, I use TT. They are the world's fastest commercially available futures trading platform. Learn more at tryttnow.com. RJO is a long-standing brokerage firm with personal broker relationships to help you learn and trade futures. To learn more, please visit rjofutures.com. So for me, a couple things you said I want to talk about. First is
Sure.
You said that a higher VIX brings you to the shorter term, and that brings you to futures.
Mm-hmm.
And I found that to be very interesting because I always say, every time the market starts to go down or the VIX goes up, it's a time that you want to be long CME stock or all the exchanges because everybody's going to be a lot busier.
Right.
And I think it's a lot easier said than done for a lot of traders to just make that switch. Okay, the VIX is, rallying. Now I move into start trading futures, even though you've been,
Right.
tell me what mostly been trading stocks probably or whatever else it is that you were trading.
Sure.
And then now you jump into futures and it's really volatile. Talk to us
Right.
about how you kind of have that balance between the two.
Yeah, actually, that's a great point. And actually, that's something that I hadn't really thought of it in terms of it's not something someone can just jump in and do. One of the big sort of turning points for me on that, I want to say 2015, but there was that moment prior to the decline in 16 when we had a lot of the news flow was Europe and Greece at the time. And there was a back-to-back, 4 sessions where we dropped 200 points back then. That was obviously more on the Dow, I want to say. Overnight came all the way back, engulfed it. did it again to the downside, and then did it again to the upside. And all of that happened, I want to say, somewhere in May, and then by June, and then we fell in August and all that. So around then is kind of when the market hadn't gone anywhere for 6 months. I had always, traded futures, but nothing in this sort of like, let me jump in and get a bigger sense of it in this sort of short-term time frame. It is way different if you haven't done it. The principles remain the same in the sense of, you think about moving a stop, you think about, managing a trade. Are you going to add to it if it drops? Is it already a full size? If it moves, you take some off. Where do you move your stop, break even? All of that is the same, but it speeds up. And so for me, what I found is, right, so it's kind of like, if you have that going on, then you say, okay, is there enough vol here to make it not even worthwhile, but because I can't figure out what's going on with the rest of the market during that time. Nobody can. And so that's the idea, is in those moments, you can kind of get a bunch of similar plays in the same structure, long, short, moving your stops, that you would in those longer term positions that you don't have to think about at that moment. And it's helped because most people don't realize what can happen in an overnight session and what can happen the next day. And it has no bearing on where you're going big picture, so it's a great point. I hadn't thought of it. I really hadn't thought of, it's not something you can just jump in and do, but I found that it's helpful because it's so liquid and sort of, you're able to maneuver. And if the vol is right, then you have an opportunity to say, I'm not paying tons of attention to my other stuff that often I'm using weekly levels for.
Yeah, I mean, I think one of the major benefits of futures is obviously the hedging if you have big portfolios. And I'm talking really the benefits of futures for those that are trading, stocks or ETFs. When we start getting busy, the futures really they allow you to be able to, like you said, capitalize on the shorter term movements to where either you're hedging against your bigger portfolio, you're capturing an intraday move. To be able to say, look, on the big picture, I'm still going to be positioned this way, but right now, this is something that I see this could happen today, multiple days, and it doesn't. You could actually capture some, alpha by trading the futures while not changing your other core position. But like I said, initially, it's so much easier said than done because I look at myself and I'm a futures trader. And I don't trade any stocks. So when we get slower, I just take time off. I don't go and trade stocks. So for me, it's hard to see how someone does that. But I know that this is a growing part, specifically for the futures industry. So I really want to focus more about how you do that. Because it sounds like you're very structured, right, in your process. But how you go about your longer term stuff from stocks and then how you take that same process, and I know that you said stops are the same, and like how maybe some of your execution may be somewhat similar, maybe the basics about it, but talk to us about how the actual strategy carries over to futures.
Yeah, absolutely. And in fact, it's great because I there's so many components to it, but one I was just thinking as you were mentioning, like, part of that is, it's not just saying, hey, I'll go trade some futures now because the VIX is up. It's kind of like, okay, what does my longer term stuff look like? Generally, that's shaped out anyways. The market can adjust how much is long, short, where are you going? But ultimately, the factors drive that. I'll talk about that. But part of this first is just saying, okay, how much actually would go to that intraday work? Assuming you had all your stop stuff figured out, which already is its own risk issue. If you haven't traded that and you don't understand it, then you won't know what you're doing with your position sizing once you even taken that sleeve. But part of this, for me, the genesis comes sort of from a wealth management background a little bit, where, and before that, just getting clobbered in the past. I mean, I've been through so many cycles, and I went through this period where, you could make a ton, even on a relative basis or in an absolute, either way, but you're young and you're kind of pushing and you've got two positions and you think you made it. And then you go through these periods where you just, you'll grind and give all that back. And I've done that. I've done that numerous times where you're like, okay, here's, these smaller option positions that are out of the money. And I might have even broke it up into pieces thinking I'm managing something. And in the long run, you're just killing your time. And so that led to a larger sort of journey of like, how do, individual positions tend to work. People have seen some of my factor work on single stocks. We break them out into growth strategies, value strategies. Even those are broken out. So that's where the swing and intermediate kind of comes from. And it's structured in a way where there's diversification in that. If you look at the standard stuff, if you have over 25 stocks, you tend to lose the concentration effect. If you have like under 5, now you're in a world of randomness and luck, you know. So it's a 15 to 20 something position thing. It moves. It has macro, long, short. I tend to be way more like, I am not fixated on, is this the most value stock ever? Is it in my strategy bucket list? Does the chart work? Does it fit in? So once you give yourself some room around every sort of discipline, then you can start to structure out where does your capital kind of go. And in that way, there's a longer term, a shorter term, and then this future sort of piece. And I had a tweet, this is a long time ago, but I had thought about it because I remember when I started this and I said, okay, now my portfolio is only moving, 3 or 4% a day, let's say, back then, versus, you could do these crazy swings. And then I would say, is this really working? But you realize if you can do higher than the average, on the market on the up days, hopefully over the term, not destroy yourself on the down days, that active portfolio can do well. And that for me was kind of the bigger revelation into building. And so I wrote this thing about if you spend 80% of your time on your structure, right? It's not about my structure or anybody's, it's about what's yours. And as you said, like you have futures, you take time off when they're not. Yeah, during that time, I don't have an open futures intraday thing, but I am going back to some of the stock stuff. And the beauty is if you don't want to, like if you have the time to not, then that's great. But it fits in the time frame and the buckets. And so I just had said, if you had 80% of your time spent on what's your strategy and your structure, that may change, but spend that there, then spend 20% of time what you're going to put in it. The trade management piece and all that's a little bit different. But that to me, it definitely slows your return. It changes the nature of the game. But that is something that I think if I were going back again, I would have started that process way, way earlier.
I actually want to get into a little bit about something that you and I, we don't agree on. And I want to just have that little discussion before we talk about the book. And most people listening to this already know that I believe heavily into trading psychology and how I believe that that's so important, because I think that anybody could learn charts, anybody could learn fundamentals. And I went through this in my career when I was first developing my strategy, that it was like, okay, I feel like I have something that's good here. And then when it came down to the execution of it, I felt that I just needed to get better at that. And I needed to get better at psychology, just like handling being a trader. I just think that there's a lot of art that goes into it. And you actually feel a little bit differently. You're on the other side.
Okay, I am fundamentally a stats guy. And because of that, I'm very much into the idea that if you can't express it in numbers and you can't measure it, it may still exist, but it's not important. I only believe intangibles become important if they affect something tangible. So, in the baseball argument, I'm very much a stats guy rather than a team chemistry kind of guy. I believe in the numbers. I don't believe in scouts. But I think it's interesting, something you said there. You said you believe in psychology is more important, but then you said because anyone can learn. So that's sort of where I am as well. I think edge, positive expectation in a trade, is the most important, because like you said, anyone can learn it, fine, but you have to learn it. If you don't have a trade with positive expected value, you can have the best psychology in the world and you'll still lose money. Having said that, I do think psychology is important, and bad psychological makeup can wreck the best edge there is as well. So edge, I think, is most important. But I don't really, we could have this argument and go back and forth forever. And I'm not really interested anymore so much in convincing other people that I'm right. I want to sort of put out my ideas, and other people can sort of take them and use them and, work from them. You just can't convince some people of some things, and maybe I'm not right.
Well, yeah, that's what I like about you
at this point of my life.
That's what I like about you, and that's what I like about your books. I mean, you just get right to the point. I mean, you don't fool around. You talk about. I could tell that you're a numbers guy just from reading your previous book, and going back to that discussion is what's more important, right? And I think that yes, everybody needs to have some statistical edge. Everybody needs to have some sort of strategy, right, that's structured. But I believe that
you can't make money playing the lottery.
Yeah,
right?
You can't just go in there and be like, hey, my psychology is great. You can't go in there. It's like, I'm looking at it this way. So you have Tiger Woods, right, who I think is one you would look at who is probably got the best head on his shoulders when it comes to golf. But he's got to learn how to swing first. Like, he needs the fundamentals. I mean, when it comes down to it, he's just the best at the moment at seizing the moment. I look at that a lot as a trader, right? Because if you don't have those basic fundamental skills of understanding, the technicals and the fundamentals, then really you can't. A good trading psychology doesn't matter.
I'm just agreeing. Like Tiger Woods, his psychology is wonderful. But if my psychology was as good as his, he's still going to beat me by 20 strokes, right? Because his technicals are there. So it's kind of like, in baseball, you can be the best clubhouse guy in the world, but if you can't hit the ball, you're not going to be in the majors. So given you're in the majors, then being a good clubhouse guy is great. So it's kind of interesting. Whenever we have this, people always start off like this is an argument, and we normally kind of end up agreeing.
Yeah. I can see that.
Let's just take as a given for a second that trading psychology is really important, right? Traders don't do anything to get better at it. It's kind of knowing that you're a weak person isn't going to make you strong. Knowing that is the first step, and then you go to the gym and then you work on it. But traders oh man, I've got to get more disciplined. And they sort of sit there and try and will themselves into a state of discipline. And that just doesn't work. They've got to work on that skill like they'd work on anything else. And I just don't see it. I don't see traders going to psychologists. I see them reading garbage and looking at YouTube videos, following someone on Twitter. But you've got to really work at it with someone who really knows what they're talking about. And so I don't know if traders really believe psychology is important as much as they say it is, or whether they just haven't. Maybe a lot of traders just don't do any work. I don't know. People look for easy answers, right?
I think nowadays you have really two different types of traders. You have the people that really put the time in, and you have the people that open up the account the next day are trading. A lot of people call them the Robin Hooders or whatever, right? They come in, they look for the quick buck, and they either quit or they eventually find themselves to become like the other person. I mean, if you're always finding in the middle, in my experience, you're either going to be one of the other two, the person who does it for a short period of time and quits, or the person who becomes devoted and this is what you want to do. I mean, the market weeds everybody out. And, I don't know in my experience that I have been around too many traders that have been doing this for a long time that they haven't found the full commitment to maybe some work harder than others in different facets, but I think they all work hard in trying to get better. And I think that I want to stay kind of back to where we were talking about whether or not this is an argument to where we both agree. And I think that we definitely do. I think we do agree, because it's like, I think once you get to the point to where you have found the strategy, then I think the psychology, and actually I think more important than psychology is execution. And that's just getting really good at executing your strategy, unless it's automated, because that's something else that I talk a lot about, is that it's not just about, and I kind of think this kind of blends with psychology, execution, being able to recognize your strengths and your weaknesses of not only yourself, but your strategy, and then being able to execute at the highest level. And I think that's really, the better executor of the same strategy, the person who has the better psychology and the better execution skills, will supersede any numbers. So that's also where I look at it and say the whole thing is a process to get to the point, but then once you get to the point of the numbers, in order to excel beyond them, beyond the numbers, that's where execution and psychology become more important to me.
Well, I think you can put numbers on the execution as well, but I do agree. But I think it's a separate part to the strategy. It's not the core. But something you said was really interesting about working on your strengths and weaknesses or recognizing them. I think trading is something where working on your weaknesses is the wrong way to go. I think you should concentrate on your strengths because a lot of things in trading are quite transient. And I hate it when I hear a trader who's like, I've got this nice strategy, it wins this, it's got this winning percentage, it's great. I'm just keeping it small, trying to grind away. I'm like, you're the dumbest person in the world. You should be trading that as big as you possibly can because it won't last. And I think you shouldn't try to work on weaknesses. You should try and exploit strengths. So it's not like, your example about Tiger Woods. Golf is a game where you get the best bang for your buck by working on your weaknesses because you have to do everything. You have to drive, you have to chip, you have to putt. But in basketball, there are plenty of guys who've had great NBA careers and all they could do was shoot. It's like there are guys in the Hall of Fame who couldn't defend at all, who just didn't bother defending, right?
Yeah.
So I kind of think trading's like that. It's like work on your strengths, acknowledge your weaknesses, and try and put yourself in situations where they're not the important thing, but then really work on your strengths.
Because I've spoken with you in the past, and obviously you put a lot of content out. I read a lot about how you actually talk a lot about the VIX, but you also talk a lot about spread trading, like the Russell versus the S&P or the NASDAQ. And that's something I think this year specifically, I've seen more and more traders talking about spreading between the markets. I mean, just look at the NASDAQ, the way it's been so different. I mean, versus the S&P and the Russell, they all have the charts look similar, but they do look different in a lot of ways in the way they've been acting. So I know a lot of my friends have been trading that way this year. So talk to us a bit about that process and how you go about spreading the indices.
Sure. I basically, like you said, they all kind of move in the same direction. We do get some ridiculous divergences every once in a while. The biggest divergence that before this year, the biggest divergence that I can remember with respect to the Russell versus the S&P, which is really the two that I like to pair up with each other, was after Trump was elected. I think you had an outperformance of the Russell 2000 by about 10% or so relative to the S&P 500. And then over time, they both came back in line with each other. It's been opposite lately, where the Russell 2000 has been the underperformer. What's been going on in the world, I think, is perceived as a negative for smaller companies, maybe for companies that don't have as much sway with being declared essential and getting to open during all of this. But for whatever the reason, we've had that S&P outperformance versus the Russell 2000. Now, the first thing that really caught my eye about trading the two against each other was what happened back in 2016. But before that, I had done a lot of pair trading individual stocks versus each other, and had tried to apply it to the relevant ETFs, and never really found much there. I think the environment changed enough, and maybe more people are trading ETFs, which in turn will impact the various index performance. But there's been more opportunities to trade the two against each other. And what I think kind of solidified it for me is the micro futures that came out this year. I would trade the slightly bigger mini futures versus each other, but now with the micros, I think it gives you a chance to reweight yourself periodically. If you want to be right now, I'm long the Russell, I'm short the S&P 500. I've been in and out of that position a couple of times over the last couple of months. With the micros, you get just so much more flexibility with how you're sizing things up and sizing things down, that you can go from being, let's say, equity market neutral, but long Russell, short the S&P, to slightly short or slightly long the overall market based on, what your feeling is right now. So I think that combined, that there's been more of a divergence between the two. I don't know if it's because there's an increased awareness that there's so much fundamental difference between the S&P 500 and the Russell 2000. And then there's a relatively new, very liquid product that allows us to trade the two versus each other.
So I definitely understand your reasoning for the spread. I want to talk a little bit more about how a trade develops. What's the ratio between the two? So you said that right now you're long the Russell and short the S&P. Take us back to before you got into that position and walk us through that process for you wanting to get in and how you're managing it.
Okay, well, going back, and I'm doing this off the top of my head, so if I misquote or misidentify a couple of dates, and I'm happy to be fact checked, and I'll go back and check for the specifics. But as this situation developed, you did see a ridiculous divergence between or among the NASDAQ, which we're all aware of. Just because some of the larger NASDAQ companies have fundamentally benefited from what is 2020. But I started to see that the S&P and the Russell were going in opposite directions. I recalled just from history, and I think one of the things that makes us older guys a little bit better than the younger guys at trading is we do have some history to rely upon. I know that the two generally don't diverge by more than 10%. And that's just outperformance one versus the other. I think we reached that point in, mid to late June. And that's when I started easing into the position. Initially, I didn't really want to pick a direction with the overall stock market, really because the attitude about the COVID situation and whether we're going to get through it or not has been very fluid. If, we get announcement out of Russia, which came a little bit later, that they've got a vaccine and everybody likes that, and both equity markets rush up tremendously to get the Russell actually outperforms a little bit. But I really haven't felt terribly comfortable because I don't feel like I have a really good feel for why stocks are doing what they're doing. So typically I would do, long 2 Russell futures versus short 1 S&P future, which with the, that's pretty close to market neutral. The quoted value of the Russell 2000 is about half that of the S&P 500 right now. If I start to feel like we're topping out, I'm actually a little bit more comfortable with being more short S&P futures than long Russell futures, because it does seem like when we get the moves to the downside, that's really where you're seeing the Russell underperformance. So when I'm getting overweighted short or more short than long in this current environment, it really does involve being more short S&P futures than adding to the long side on the Russell 2000 futures. There was one instance where I think over just 2 or 3 days, we got about 3% outperformance of the Russell versus the S&P 500. And at that point, I actually got flat for a couple of days. And then the spread between the two widened back out. And then I got back in a neutral position. And as of late August, that's where I was. I was basically, we always tend to see the equity market run up a little bit into the end of a month. And so I decided to stay, net neutral through the end of the month. I assume I'll be taking advantage of the volatility around the difference between the two periodically throughout September and October. I'm not sure what I'm going to do as the election approaches, because I think a Trump victory is probably better for the Russell than the S&P 500. I'm not really sure if a Biden victory is better for multinational companies or not, or if that's already priced in. So I've really, I'm going to keep a close eye on it starting mid-October with respect to election news, polling news, and how that relationship is working out.
Thank you for listening to Futures Radio Show. If you enjoyed the show, please leave a review on iTunes. You can listen to all of our episodes on futuresradioshow.com, iTunes, YouTube, Google Podcasts, Spotify, and Stitcher.